In today's video, we're going to fix 10 common Roth conversion misconceptions that we commonly see or receive questions about. Let's get into it. Number one is by far the most common, and I completely understand why, because the math here is not incredibly intuitive. There is no inherent benefit to a Roth IRA or compounding wealth tax-free. Let me explain. The US tax system is incredibly good at forcing you to owe taxes at some point, but it gives you the optionality in deciding when to owe taxes. For instance, in the case of Roth contributions or conversions, you are basically deciding to pay taxes today and compound that money tax-free. But in the case of a traditional IRA contribution, you choose to save on taxes today and instead defer those taxes into the future. Given this, there is a reduction in our wealth at some point due to the tax rate we're paying. So one can basically extrapolate this out, run a bunch of scenarios, crunch a bunch of numbers, and what they will find is that the decision of whether a Roth conversion makes sense or whether they should just keep that money in a traditional IRA comes down to the tax rates they are paying. What tax rate are they paying now versus what tax rate would they be avoiding in the future? If you pay the exact same rate in both scenarios, I mean on the conversion or in withdrawing from your traditional IRA, then there will be no benefit or cost to a Roth conversion. You can see this proof simply on the screen. It doesn't matter the sequence of returns. It doesn't matter the sequence of withdrawals. Everything comes down to that tax rate. Pay a lower rate today than you would otherwise see in the future. And this is where we start to see Roth conversions really make sense and benefit your scenario. There is no inherent benefit to compounding Roth dollars outside of this. Number two is less of a misconception and honestly more of a pet peeve on my front. And I'm seeing this more and more frequently. If you look at Google Trends, Roth conversions, specifically for retirees, is a topic that's been steadily growing in popularity over the last couple years. And it makes complete sense why. We have a lot of videos showing the reasons why. I view this as a positive. It's been a greatly underutilized strategy. But a few years ago, you'd see a lot of advisors steer away from tax discussions and instead tell their clients to just simply talk to their CPA. Well, over time, those advisors would lose portions of their clientele because that clientele rightfully demanded that tax planning be part of the services that the advisor offers. Based on these two dynamics, we've seen a lot of unequipped advisors start recommending a Roth conversion strategy when their clients ask about it. Here's a recent situation we saw in our practice. We were reviewing this retiree's tax situation from last year. This couple was over 65, one spouse had already been drawing Social Security, and on top of this, they had a decent pension and also had some dividends and interest that effectively fully made up their income need. They didn't need to tap their other accounts. The tax graph of this situation is on the screen. Now, this couple had about $2 million in tax-deferred accounts that they really never needed to touch. So this couple, after seeing some content on how costly required minimum distributions can become, went to their current advisor and asked if they should be Roth converting. According to this retiree, this advisor kind of talked around the issue, but then ultimately recommended a $150,000 Roth conversion. Now, I'm fairly young, but this is the kind of stuff that gives me gray hairs. As you can see on the tax graph, this $150,000 conversion made absolutely no sense. This retiree's income was pushed beyond an IRMA band, which means they're going to owe an extra couple $1,000s in Medicare expenses and only went a few $1,000s over that threshold zone. They pushed through a zone where all dividends and interest this client had now has an extra 3.8% tax tacked on. This target, again, made absolutely no sense. And unfortunately, I see this too often. In general, if your Roth conversion target is a nice, clean, round amount, like $150,000, it's a good chance your conversion strategy is suboptimal. As we think about tax rates or hurdles you're going to face in retirement, you're almost always converting to some given target that gives you an unclean number, like $142,361 or something like that. Now, I'm not trying to get so exact that if an advisor or a retiree rounds this number down to a clean $142,000, again, I'm not going to have an issue with that. But the odds that your optimal target is some really nice, clean number is very low. This should be a warning sign. Misconception number three, converting for the next generation. Now, converting for the next generation, let me be clear, is a completely viable reason for Roth conversions. But where I see issues with this reason is that it can lead to mistakes in the extremes. When we map out your forward-looking tax plan, you may see that taxes just keep growing out of control for really the remainder of your life, this kind of ever-increasing staircase that you see on the screen. But the problem in retirement and tax planning is we don't know exactly when you are going to pass away. Are you going to live long enough that you personally will have that large growing tax liability? Or could you pass away early and instead pass that liability on to the next generation? What effect will this have on your Roth conversion strategy? Should you get more aggressive, or should you actually pass on that liability to the next generation? Here are two extremes I see. Number one, people wanting to convert everything early in retirement so their heirs don't have a tax liability at all, regardless of when they pass away. Or number two, not even caring about their heirs, because once you're dead, well, you're dead, and maybe your heirs should be happy with anything that they receive, whether they owe taxes on it or not. Neither of these views makes financial sense. Here's what happens when you pass away with traditional IRAs. Your heirs inherit these IRAs, and they effectively have 10 years to withdraw from these IRAs and completely exhaust them. Now, if you leave big IRAs to your heirs, they're going to be forced to take some pretty big withdrawals on top of whatever income they already have. This may push them up into some pretty high tax brackets. This should be viewed no differently from a tax rate standpoint when you compare your tax rates versus the tax rates they may have to pay. Again, ultimately, it's your wealth, and you want that wealth to benefit that next generation. And we want to, again, minimize taxes across your life and as well after your life. On the flip side, unless your heirs are already in some pretty high tax brackets, your goal should not be to convert everything by death. Consider leaving two kids a smaller $200,000 IRA. That IRA is split between two heirs, and they have 10 years to each exhaust that $100,000. They can probably withdraw quite strategically and pay some pretty reasonably low rates on those withdrawals that make more sense than big conversions earlier in retirement. So 100% the next generation should be factored into your conversion plan, but it probably shouldn't be the driving variable. Number 4, you need to wait 5 years to withdraw from your Roth conversion. Many people have heard the 5-year conversion rule. As the IRS documents explain, every conversion you do starts a 5-year clock where you cannot touch that conversion for, 5 years. So if you convert today in 2024, you cannot, quote unquote, touch that conversion until 2029. Well, heck, doesn't that ruin some of the value of a Roth conversion? What I find is many miss that there are some exclusions to this rule. One of those exclusions is if you're 59 and a half years of age. The 5-year conversion rule in this instance does not apply to you. You could theoretically convert at age 60 and access that conversion immediately. Given this, the 5-year rule only applies to those younger than 59 and a half. Number 5, will a Roth conversion prevent you from contributing to a Roth IRA? No. Many of you know that if you make too much income, you can't contribute to Roth IRAs. The table on the screen shows these income limits. But if we are Roth converting, we are technically raising our taxable income. So doesn't this mean it will disqualify us from contributions? No. If you read further into the IRS documentation, you will see that they will take out your Roth conversion from this income limit for the sake of Roth contributions. That modified adjusted gross income number is before you would have performed that Roth conversion. Therefore, your Roth conversion will not and does not affect that contribution eligibility. Number 6, Roth conversions only make sense if you have savings to pay the Roth conversion taxes. This is simply not true, and I don't understand where this idea came from. It is true that paying taxes from savings is the best. The main reason for this is that your taxable accounts or savings are a leaky bucket. Each year you earn interest or receive a dividend, and it is taxed directly to you in that given year. So when we're compounding on an annual basis, but that compounding is slowed by our annual taxation, that's obviously going to slow the growth of that account. So by paying taxes from this account, you are effectively moving money from your savings into your Roth because you're keeping more of that conversion going towards that actual Roth IRA. But what if you don't have savings? Don't worry. Just pay the taxes right out of the conversion. How could this possibly ruin the value of a conversion? Say you never converted and instead withdrew income directly from your traditional IRA. Well, how would you pay the taxes on those withdrawals? Most people would simply withhold those taxes directly from that distribution. So how can it possibly be bad to simply withhold taxes then from your conversion? It's the same as if you made a big withdrawal. Number 7, if you perform a Roth conversion, you don't have to pay taxes until tax time next year. This is false, but the timing of your tax payments can vary based on how you're paying those taxes. Now, if you're withholding taxes from your conversion, you actually have until December 31st of that year you made the conversion to make your withholdings. So you could perform a Roth conversion in January, withhold absolutely nothing. Then in December, you could do a distribution and withhold everything from that distribution that you need for taxes, and that is completely satisfactory. In this scenario, you get to earn interest on those tax dollars for, well, an extra 11 months in that scenario. But if you're paying taxes from savings, then you need to make quarterly estimated payments. Now, this process can get a little bit complex based on your situation, and explaining this thoroughly is beyond the scope of this video. But just know that you will owe an estimated payment in each quarter following that given conversion. A simplistic example would be something like this. Let's say you do a $150,000 conversion in January, and that conversion generates $35,000 in taxes. A simple and conservative way to pay these taxes is simply splitting up equally amongst the remaining 4 quarterly deadlines. Now, there are other ways to calculate out your estimated tax payments, and there are some safe harbor rules that you can certainly use. But just know that you can't wait until tax time in many Roth conversion cases. Number 8, within our practice and discussions with clients, we believe it's very important to nail down the exact goal of your Roth conversions, because there isn't just one goal, or rather, based on the changing of this goal, the right answer changes. For instance, a really aggressive Roth conversion strategy might be the best tax saving strategy in, let's say, the top 25% of retirement simulations that we run. But it may be a strategy that leads to tax losses, or at least a suboptimal strategy in the bottom 25% of simulations. On the other hand, you might find a conservative strategy like maxing out the 12% bracket will be a strategy that is expected to lead to tax savings in all scenarios, but maybe is only optimal in the bottom 25% of retirement simulations. So again, what is the goal? What are you aiming to gain? And what are you willing to risk in the goal of that gain? What I mean here is Roth conversions are a holistic discussion. There isn't just one right answer. One strategy could be the best if you live to age 78, but if you live to age 88, a completely different strategy wins out. The right answer will change based on the assumptions and the goals that you have. Misconception number 9, aiming for a tax-free retirement. Now, a tax-free retirement sounds great. It's great to brag about to your friends, but that's about where the greatness stops. Your goal should not be to have a tax-free retirement because it's likely financially suboptimal no matter what way you look at it. Again, there are very few ways to avoid taxes here in the US. And remember, whether a conversion makes sense or not comes down to the tax rates that we pay on that conversion. We have a progressive tax system here in the US where the more income that you make, the higher tax rate you will pay. So let's say early in retirement, you converted at 12% or maybe even 22%, and you got to a place where all of your IRAs were completely gone, converted to Roth. Now, that might sound great, but now for the rest of retirement, you are leaving a 10% bracket unfilled. You may even be leaving part of that standard deduction unfilled, which would be obviously a 0% bracket. And going back to the math in misconception number 1, it makes absolutely no sense, or at least financial sense, to pay a 12 or 22% tax rate to avoid a 10% tax rate later. And so your goal should be to spread out tax liabilities as wide as possible through the remainder of your life to maintain the lowest rates in this progressive tax system. This means in the vast majority of cases, you should want to pay some level of taxes. Tax-free is not the goal here. And finally, the last false belief that we see retirees thinking is that they need to be done Roth converting by the time required minimum distributions start in their 70s. And I totally understand this logic. If we receive an RMD, the only way to minimize future RMDs is to Roth convert on top of that required minimum distribution. So it would seem that Roth conversion planning certainly becomes more difficult, and that's completely right, but it's not impossible. Again, in this progressive tax system, we want to spread out tax liabilities. Well, understand that RMDs start out relatively small, but grow over time. So in the first decade of RMDs, we typically find that many retirees with substantial IRAs are better off leaving some of that IRA balance into their 70s and then converting above that regular RMD. If your Roth conversion target, let's say, has consistently been $80,000 and your first RMD is only $45,000, well then why would we believe we need to stop just because we received an RMD? You still have room to convert above that RMD. Now, something worth noting on this front is that when you are converting well on RMDs, you need to take your RMD before you actually do any conversion. Also know that you cannot convert your required minimum distribution. You need to fully withdraw that specified RMD amount sometime earlier in the year, and then you're able to Roth convert. Converting in any other order will lead to big problems. Okay, so we went through a lot of information and covered a lot of Roth conversion misconceptions today. If you have any questions that maybe weren't answered in this video, include them in the comments down below. For the sake of time, we couldn't go as deep on some of these topics as you may need us to. Well, luckily we've dove deeper on some of these topics in other videos. Here are 2 videos discussing why you shouldn't want a tax-free retirement in one video, and then another video discussing 3 cases where a retiree may actually want to convert all of their IRA assets. Click on these 2 videos to learn more, and always remember, you don't need more money, you need a better plan. Thanks so much for watching today. We'll see you in the next video.